Hey, yo, what is up, everybody? Coach Chad here, CEO of the NLCA and creator of the Assistant Coach Academy. I hope you guys are doing well. I'm going to dive right in. I'm a little short on time. I got a meeting coming up, but I took a scoop of pre-workout and I said, fuck it, I'm going to record a podcast. So here I am recording a podcast, and today's topic is going to be how to pay yourself as a CEO. And no, that's not me peeing. That's me pouring water into this cup here. How to pay yourself as a CEO. All right. So why do I want to create this podcast for you guys? Now, I actually don't think this is talked enough about by business coaches, maybe not even talked about at all. But the likelihood that your business lasts more than 5 years is actually really slim, which means as a CEO, we have to capitalize on this short window of time and extract cash flow from the business and put it into our personal accounts, and then learn how to invest that money so that we can grow our wealth, right? Because let's just talk in theory here. If you only have a 5-year window with your current business, you got to have a plan in place to pay yourself, or else the 5 years of work of growing that business were really for nothing, right? Because what I would hate wow, I can't speak, too much pre-workout maybe. What I would hate to happen to you is you get to the end of your tenure with your business and you're like, holy shit, I never had a process for extracting cash from my business and paying myself. And now I'm at the end of my business and holy crap, I'm broke. This was all for nothing. I would hate for that to happen because, like I said, the percentage, I don't have the exact number, but I know it's slim. The percentages of businesses that last more than 5 years is very slim. The percentage of businesses that last 10, 20, like decades is very, very slim. And also the percentage of business owners that actually successfully sell their businesses is also very slim. So don't rely on an extended timeline with your business. Obviously, we are going to work towards that. And we want to extend the timeline of our business as long as possible, but don't rely on that, right? Because that's very risky. And two, don't rely on your business thinking that it's a guarantee that you're going to sell your business and cash out for millions and millions of dollars, because that's not a guarantee either. So hopefully I've sold you on the fact that you need a consistent monthly process where you're paying yourself so that once again, hopefully this doesn't happen, but when the point comes when your business is over, you've successfully cashed out a large amount of money from your business. And by the end, you're not like, holy crap, I didn't fuck up this whole entire process. All right. So what I'm about to give you is not financial advice. It is not investing advice. I have to say this. This is my process that I've learned over the 7 years of being an entrepreneur. And if I had this information in the beginning times of me being an entrepreneur, my financial status would be much more well off than it is. Like I said, this is an extremely important process. You have to learn how to extract cash from your business and pay yourself so that all of this isn't for nothing. All right. So this is the process that I personally have developed for myself over the 7 years. Once again, not financial advice. I'm just going to talk you through what I personally do. Okay. So the very first thing is defining a monthly distribution from profits. Okay. So first off, coaching businesses, we don't have very large expenses, right? I mean, it depends on the scale of your business, but in large part, most coaching businesses should be over a 50% margin. Most coaching business should be in between a 60 to 80% margin. If you're above that, that probably means that you're pretty new. If you're below 50% margin, probably means that you have to start looking into what you're spending your money on. But on a monthly consistent basis, and the reason I say that is on a monthly consistent basis, you should have a distribution percentage of profits. All right. So at the end of every month, you should say, all right, these are the profits from the business. And this is the percentage of the profits that I'm going to pull from the bank account and pay myself. And you should at least have a full month's worth of expenses in your business bank account. Ideally, at least 3 to 4 months. Some business people say 6 months to a year. I think that's a little too conservative. I think if you have at least 3 to 4 months of business expenses in your bank account, you're in a pretty good place because, like I mentioned, coaching businesses expenses really aren't that much. All right. So getting back to step number 1 here is we have to define a percentage of profit distribution that we feel comfortable paying ourselves monthly. Now, when I say comfortable, it's all right. How are our expenses? What's the trajectory of our expenses in the next 3 months? Are we going to be spending a lot of money on growth, like ads and bringing on employees and other aspects? And if that's the case, then the percentage of profit that you're going to pay yourself monthly is probably going to be a little bit lower. But if it's pretty stable, the percentage of profit that you're going to pay yourself will be a little bit higher. Now, I go through that exact analysis on a quarterly basis. So every quarter, I'm like, all right, what are the next 3 months worth of expenses? All right, how does this affect my own percentage of distribution from the profits monthly? Great. And then I come up with a number. All right. So let's just say theoretically it's you're going to take 50% monthly, right? And then, like I said, every quarter you'll go back to the drawing board, you'll analyze the next 3 months worth of expenses, and you'll come up with your distribution number. But step number one is defining that distribution number. And you're going to define that based on the amount of expenses that are going to come out in the future. If it's pretty stable, the higher your distribution could be. If it's like you're going through a massive growth cycle, you probably want to save a little bit more in the business just to be safe. It doesn't mean that you have to save 80 to 70% in the business, right? But you have to save at least enough to cover those future expenses. All right, so step number one, you defined the monthly distribution amount. Once again, the distribution amount, sorry, I was just looking at my dog. The distribution amount is from the monthly profit. So at the end of every month, this is the profit, this is my distribution percentage. Great, you're gonna pull that amount out of the business bank account and you're gonna move it into your personal bank account. So that's step number one. And I have a little example here that I'll go through, okay? So example, let's say your profit was $50,000 and you want to take 50% of every month's profit as your distribution. That means that you're going to transfer $25,000 from your business bank account to your personal bank account. Step one. All right, step number two, you're going to take your monthly distribution and multiply it by your tax bracket percentage. All right, this is a question that you can ask your accountant. Hey, what's my tax bracket percentage? All right, so for example, mine is 37%, 0.37. All right. So at the end of every month, the very first thing that I do is I pay the government. And what I mean by that is I take my monthly distribution and I multiply it by 0.37, and whatever that amount is, I save that in a tax account. All right. The reason I save it in a tax account is because, and I've never been late on an IRS payment. I've, in more times than not, overpaid the IRS. And the reason is because I do this process every single month. You do not want to be late on the IRS payments. You do not want to fuck with the IRS at all. So pay them first. All right. Just this is the simplest and easiest way to keep them out of your hair. All right. So very first thing I do, take my distribution amount, multiply it by 0.37 because that's my tax bracket percentage, the 37%, and I transfer that amount into a separate account that is titled my tax savings account. Never touch the money in that account, literally just for taxes. When I pay my quarterly taxes, it just comes right out of that account. Okay, so sticking with our example here, like I said, the profit's 50,000. This individual is going to take a 50% distribution, which means they transfer $25,000 out of the business account. They move it into their personal account. Let's say that this individual's tax bracket is 30%. So they take 25,000, multiply it by 0.3. That's 7,500. They just transfer that amount right into their tax account. Boom, already paid the IRS. Don't have to worry about it. Okay. So the next thing that I personally do is I allocate a set dollar amount to go to my financial advisor every month, in which they invest for me. And in large part, that's in the S&P 500. I think I talked about that 1 or 2 podcasts ago, my investment strategy. So you can go back and watch that podcast. But the next thing I do is I allocate, like I said, I allocate a set dollar amount to go to my financial advisor every month, in which they invest for me. In large part, that's like in the S&P 500, bonds, stocks, things of that nature. Okay. Now, the reason I pay them next is because the reason I'm getting into business is to take my earned income that I had to trade time for, that I had to work for. And my goal is to take my earned income and invest it and create passive income, so that eventually when the day comes that I don't want to work, or maybe I can't physically work anymore, I don't have to, right? There's no necessity for me to spend my time working, because I've already allocated so much cash into my passive income that I already am making a living from that. All right. So that's the goal, and that should be your goal, because that's how we achieve financial freedom, right? So you got to pay the IRS first. right? So just knock that one out, right? And then you got to pay your future self by investing into something that is going to multiply your money. All right. So that's why the very next thing after paying the government for me is paying my future self and investing. Okay. So that set dollar amount for me is around 16%, right? So we'll take 16% of what's left after taxes, and that amount will get invested monthly. All right, so step number 4, well, I'll just go through the example again. So once again, you had that 25,000, you're subtracting 7,500 because that's going to the government for taxes. That leaves you with 17,500. And then 16% of that is 2,800. So that's what's getting invested in this example. Then that means you have 14,700 left. Okay, so from there, I take 40% of the remaining number and save it in a high yielding savings account like Marcus by Goldman Sachs or Ally Bank. All right. And then literally, I know in my last podcast, I said, don't have money in a savings account. Well, let me explain. Okay. So like I said, every month I'll take 40% after that investment and I'll move that over to a savings account. Every quarter, I do what's called a cash dump. All right. So if I have X amount in a savings account, I'm like, man, this is too much in a savings account. And I'll invest it in some sort of passive real estate project. Cardone Capital and Blackstone are the two that I do. So I'll do a cash dump every quarter out of my savings account. I do make sure that I have at least 3 months of personal expenses. It's probably closer. It's between 3 to 6 months of personal expenses saved in my savings account. But anything more than that is too much. I'll do the cash dump every quarter, and I'll allocate that into Cardone Capital or Blackstone or some sort of passive real estate. Okay, so like I said, the next step here is moving 40% of the remaining amount after you've invested that set dollar amount monthly into the S&P or over to your financial advisor. I'll take that remaining 40% and I'll move it into a high yielding savings account. All right. And then this is the final step. The final step is the remaining amount that is left. You could do with it what you please. All right. So after you've put that 40% after the investment total into your savings account, the rest is to do with it what you please. If you want to save all that money for your personal spending, that's totally fine. If you want, for what I do is I'll take an additional 5% of what's left after I save, and I'll put that into crypto. Why? 1, it's fun, but 2, I like I said in my last podcast, I truly do believe that crypto is going to go somewhere. And I'm not going to put all my money into it, but if I put at least 5% of my money in monthly, then I feel like, that's a fair amount for myself personally. All right. So like I said, step number 5, the remaining amount is left for you. I'm just reading off my notes here. The remaining amount is left for you to do with it what you please. From here, I put 5% of the remaining amount into crypto and then keep the rest of that as my personal spending money. Very important point right here. I purposely pay myself last. I purposely keep my personal spending money low so that I am not allocating money, so that I am allocating money responsibly and keeping myself quote unquote cash broke. As my income goes up, that small percentage that I pay myself personally will increase, and then quote unquote I'm allowed to increase my lifestyle in accordance to that. So as you've noticed in this, how I pay myself as a CEO process, I personally pay myself last, and it's the smallest percentage. And the reason I do that is because where a lot of CEOs make mistakes is they pay themselves first. They give them this massive amount of money, and then they just blow it all. And then they're like, holy shit, I'm broke, right? And then their business goes to shit. And then they, like I said, they did all this for nothing. So what I do is I purposely pay myself last. It is a small percentage. And that's what I do for groceries, for rent, for my lifestyle, right? And my lifestyle is in accordance with that small percentage. And as my overall income grows, that small percentage will equally grow. Therefore, I can continue to grow my lifestyle if I so choose with in accordance to that small percentage that I pay myself. I didn't come up with that. It's something that I learned. I can't remember where I learned it from, but it's been a process that one specifically I've been doing for a while. And I'm very, very happy that I do that, because I know, 1, the amount of money that I have in my personal spending account is what I can use to do with what I want. And I don't have to feel guilty because I've already paid the government. I've already invested in multiple different things. I've already saved, right? And I can feel good about spending that money because I've already checked off all the boxes on the things that I had to do to be be financially responsible. The reason so many people get fucked up, and excuse my language, but the reason so many people get fucked up about money is because they don't do the previous things that I just mentioned. They pay themselves, they spend all their money, and then they don't have any money saved. They're late on their tax bills. They're not investing, and they're like, fuck, money sucks. No, your process sucks. So all in all, and wrapping all this up, this is the process that I do to pay myself out. Take a monthly distribution from the monthly profits. Say, if you need to save money because you have future expenses in the business account, do it. If not, pay yourself. The reason, once again, you're doing this is because businesses don't last forever. So you might as well pay yourself along the process so that you set your future self up for success. So define that monthly distribution, pay yourself monthly. From there, pay the government next, right? So ask your accountant, what's my tax bracket? Multiply that monthly distribution by the tax bracket percentage, move that into a tax savings account that money you'll use to pay your taxes quarterly. From there, allocate a certain amount into investments, right? So pay your future self again by taking money and moving it into something where your money is going to make money. And if you have a financial advisor, you can have that conversation with them. Next, take 40% of the remaining amount after investments and move it into a high yielding savings account. Then the rest of the money is to do with what you please. If you want to invest some in crypto, great, you could do that. If you just want to keep that as your personal spending money, great, you could do that. But at least you're doing it responsibly. So hopefully you guys enjoy this. If you did, let me know, and I will see you guys in the next one. Peace.